Hi, my name is Wilson Pun. I'm a real estate attorney in New York. And over the past 10 years since I've been practicing, I've helped hundreds of clients both buy and sell commercial and residential property.
Basic mortgage underwriting process. So we're going to touch base on the debt ratio, LTV, interest rate, amortization, etc.
So some mortgage underwriting considerations, the most basic ones being, debt to income ratio. They look at your gross income and they look at your total monthly debt payments. So they want to make sure that your debt payments, such as your mortgage payments, your credit card payments, your car payments, any recurring monthly payments taken as a ratio against your gross monthly debt isn't above a certain threshold. So when it comes to underwriting for debt to income ratio, typically that's going to be around 30% or less. Anything more than, the bank will be concerned that you have more debt that can't be properly serviced by your income alone. When it comes to LTV, another very popular metric, lenders typically want to issue loans that are under a certain threshold of LTV. Typically, most common we see is 80% loan to value. So what that means is, for example, if you're buying a property for $1 million loan to value, a lender will not want to give you a loan for more than $800,000. Anything less than 80% LTV is typically, as I mentioned before, the lower the LTV, the more safer the loan application is. So if you're only applying for 50% LTV, a $1 million property, meaning a $500,000 loan, you're more likely to get approved than if you were to buy a $1 million property with an $800,000 loan. So the interest rate is going to fluctuate. It's based on interest rate that the Fed sets as a benchmark. So a lot of times it's pretty much at the mercy of the Federal Reserve and how they see multiple factors in the economy that they need to sort of control whether inflation is up or down. They need to sort of use the interest rates and set interest rate thresholds as a way to, whether it's to rein in inflation or to spur growth in the economy. So what the interest rate the Federal Reserve sets then is impacted by what interest rates banks are able to offer to borrowers. So amortization is pretty much the concept of how you're able to reduce the total amount of the principal loan you borrowed, accounting for adding the interest. So whatever the interest rate is, let's say 5, 6, or 7% of whatever loan you're borrowing, they calculate the total along with the total principal and they split it up over the life of your loan, whether it's 30 years or 15 years. So on the way an amortization table looks is your initial payments, because of how an amortization works, they're mostly going to be leaning or weighted towards interest with less going towards principal. And that curve is at the tail end, you're going to be, as you're reaching the end of your loan, as more and more of your principal gets paid off, the tail end becomes mostly principal and less interest. Banks always take their interest up front, and that's typically how the amortization side works. So the easiest way to calculate your mortgage payment is probably just to look up a simple mortgage calculator. There are many that's offered online. You just plug in your total loan or mortgage amount that you're borrowing, put in the period or term of the loan term, and it'll give you a monthly payment amount, and you can use that in your calculations.
What is a real estate attorney's job when it comes to the mortgage part of the contract? How do you help the buyer securing the loan, or make sure that the loan term works in their favor from a purchaser side?
Okay, so a real estate attorney can assist a potential purchaser or their client with not the mortgage payment, but they can, for example, if you ask them for referrals, they may have worked with other loan officers before, they may have contacts with good mortgage brokers. So they're a good first step to sort of ask and get an understanding of who they would recommend or which lender they would recommend you work with. So that's sort of on the front end, the initial process. In the contract, your attorney can also help make sure the clauses are drafted in a way that protect you as the purchaser. So there's always a back and forth sort of push-pull negotiation process between a purchaser's attorney and a seller's attorney. As a purchaser's attorney, for example, I would put in certain clauses where you have protections that come into place, such as a commitment that's issued if it's subject to an appraisal, then it's not actually deemed a valid appraisal a valid commitment under the terms of the contract that would make your contingency go away. So why that's important is the contract typically has a contingency clause that states once you get a mortgage commitment that satisfies the terms of the contingency, then your safety cushion, that contingency, goes away. But what if that commitment was issued and appraisal hasn't been done yet? Your contingency is gone, but then time passes, a couple of weeks later, you realize the lender comes back to you and says, oh, we appraised the property, but it's less than what you're purchasing it for, so we have to reduce your loan amount. Then you as a purchaser suddenly are not able to borrow as much as you wanted, and you don't have enough funds on hand to be able to cover the difference. If you now don't go through with the purchase, you're at risk of losing your down payment because your contingency is already gone. So something like that, making sure that any commitment or any sort of pre-qualifying commitment or letter matches or satisfies all risk conditions before we send it out to the seller attorney is very crucial, because the contingency is one of those terms that you need to essentially protect your down payments, because the mortgage application process a lot of times is out of the purchaser's hands. You can do everything you need to submit all your financials, be responsible with your finances, making sure that the lender has all your debt information. But at the end of the day, once it goes to underwriting, once it goes to appraisal, if it's not up to a certain amount, you may not get the loan you're looking for. And if you're in trouble then, if you haven't done everything you're supposed to under the terms of the contract, you may risk losing your down payment. From the seller side, same thing. We want to make sure that whatever the purchaser and the purchase attorney is requesting is reasonable, but there are customarily sort of recognized terms that you have to sort of be a bit flexible in order to work with them to get the deal through. So typically we will see that a potential purchaser, within reason, you're giving them enough time, you're giving them certain safety precautions that are allowed customarily to go ahead and apply for the loan. And if they've done everything they're supposed to and they're still denied a loan, then you're just gonna have to work with your client that, maybe this time it wasn't this purchaser, but you can go back and restart this process with a different purchaser, and hopefully next time the new purchaser will have better luck obtaining a mortgage.